as you're watching this, the value of the dollar in your pocket is changing. Not because Congress voted on it, not because the president signed something, not because you agreed to anything. It's changing because a 34-year-old trader in Singapore just sold 50 million euros. Because a central bank in Switzerland tweaked an interest rate by a quarter point. Because an algorithm in London detected a pattern in soybean futures and executed 10,000 trades in 3 seconds. Your money is worth less than it was 8 minutes ago, or more. You weren't consulted, you won't be notified, and there's absolutely nothing you can do about it. Welcome to the foreign exchange market, where $4 trillion changes hands every single day, and nobody's in charge. Let me show you how deep this goes. Most people think currency value is something official, something decided by governments or economists in suits. And in a way, they're right. But in a more important way, they're completely wrong. Because while central banks can influence currency value, they don't control it. The market does. And the market is not a place. It's not a building. It's not even really a system. It's more like a global conversation happening in real time, 24 hours a day, between millions of participants who are all trying to predict what everyone else is about to do. And the stakes are absurd. If you're holding US dollars and the dollar strengthens by 2% against the euro, nothing really changes for you. Your coffee costs the same, your rent is the same, life continues. But if you're a German company that just agreed to buy $100 million worth of machinery from the United States, that 2% move just cost you an extra 2 million euros, money you didn't budget for, money that evaporates because of something that happened while you were asleep. Now scale that up across every company, every country, every transaction happening simultaneously across the planet. That's the foreign exchange market. And it runs on a mechanism most people have never heard of. Here's how it actually works. Currency value is determined by supply and demand. Simple enough. When more people want dollars, the dollar gets stronger. When fewer people want dollars, it gets weaker. But the question is, why do people want or not want a particular currency at any given moment? That's where it gets interesting. Imagine you're an investor in Japan. You have yen. You're looking for somewhere to put your money that will grow. You look at interest rates around the world. The Bank of Japan is offering basically 0%. The US Federal Reserve is offering 4.5%. Simple math says you should move your money to the United States. So you do. You sell yen, you buy dollars, you invest in US bonds. You just increase demand for dollars and decrease demand for yen. The dollar strengthens. The yen weakens, not by much, but now multiply that decision by 10,000 investors making similar calculations at the same time. Suddenly, the currency moves. That's mechanism one, interest rate differentials. When one country offers higher returns, money flows there, and currency values shift to reflect that flow. But it's not just interest rates. Let's say you're a multinational corporation. You make phones in China, sell them in Europe, and report earnings in dollars. Every month, you're converting yuan to euros to dollars and back again. You're not doing this because you care about currency speculation. You're doing it because you have to, because your supply chain crosses borders, and every border has its own money. Now imagine there's political instability in Europe. Nothing catastrophic, just uncertainty, an election, a policy shift. Suddenly, companies start getting nervous about holding euros, so they convert euros to dollars, just in case. Demand for dollars increases, the euro weakens. That's mechanism two, perceived safety. Currencies of stable countries become more valuable during uncertain times, not because those countries did anything, but because everyone else got nervous. And here's where it starts to get circular. When a currency weakens, imports become more expensive. A European company buying American goods now has to spend more euros to get the same amount of dollars. So inflation ticks up, which makes investors more nervous, which makes them want to hold even fewer euros, which weakens the currency further.
It's a feedback loop, and once it starts, it's very hard to stop. The irony is that none of this requires anything to actually be wrong. The European economy could be growing, unemployment could be low, but if traders think other traders are worried, that's enough. Perception becomes reality, and currency values shift based on what people think other people think. Which brings us to the really uncomfortable part. Central banks know this. They watch these feedback loops forming, and they try to intervene. The European Central Bank might start buying euros to prop up the currency, or the Federal Reserve might signal that interest rates are going to stay higher for longer, which strengthens the dollar even before the rates actually change. These interventions work, sometimes, but they're expensive and they're temporary. Because here's the problem. Central banks have billions. The foreign exchange market has trillions. In 2022, the Bank of England tried to defend the pound during a bond market crisis. They spent billions buying pounds to prevent the currency from collapsing. It worked for a few days. Then the market overwhelmed them. The pound fell anyway. It's like trying to stop a river with a sandbag. You might redirect the flow for a moment, but eventually the water finds a way through, and the traders know this. There's a whole category of investors called currency speculators who make money by betting against central banks. They watch for moments when a currency is under pressure, when a central bank is trying to hold the line, and they short the currency aggressively, forcing the central bank to either spend more money defending it or give up. George Soros became a billionaire doing exactly this to the Bank of England in 1992. He bet that the pound was overvalued and that the bank couldn't sustain the defense. He was right. The bank gave up. Soros made over $1 billion in a single day. The central bank, backed by the full power of the British government, lost. Let that sink in for a second. Now let's talk about algorithms, because it's not just human traders making these decisions anymore. It's machines. High-frequency trading algorithms that execute thousands of trades per second based on patterns most humans couldn't even see. These algorithms don't care about economic fundamentals. They don't read central bank statements. They just detect tiny inefficiencies in currency prices and exploit them faster than any human could. And they're everywhere. Estimates suggest that over 70% of foreign exchange trading is now algorithmic, which means the majority of currency price movements are being driven by machines reacting to other machines. It's a strange kind of economy where the value of your money is partly determined by whether a piece of software in a data center in New Jersey thinks a piece of software in Tokyo is about to do something. And the kicker is, nobody really knows if this makes the system more stable or less stable. The argument for algorithms is that they increase liquidity. They make it easier to buy and sell currency quickly, which theoretically smooths out volatility. The argument against is that they create flash crashes, moments where algorithms all react to the same signal at the same time, and currency values drop 5% in 30 seconds for no underlying economic reason, then recover just as fast. Both things have happened. So what does all this mean for normal people? Most of the time, nothing. If you live in the United States and earn dollars and spend dollars, currency fluctuations are mostly invisible. They show up as slightly higher prices on imported goods, a more expensive vacation to Europe. Nothing catastrophic. But if you live in a country with a weaker currency or a more volatile one, this system is existential. When the Turkish lira lost 44% of its value in 2021, it wasn't because Turkey's economy shrank by 44%. It was because investors lost confidence. They sold lira, the currency collapsed, and overnight, anyone holding lira became significantly poorer. Their work didn't become less valuable. Their skills didn't disappear. The currency just broke, and there was no vote, no referendum, no democratic process.
Just the market deciding. This is the part that doesn't get talked about enough. We live in a world where economic value is supposed to be determined by productivity, by innovation, by how much wealth a society creates. But currency markets can override all of that. A country can be productive and still see its currency collapse. A country can be inefficient and still see its currency strengthen, simply because it's perceived as safe. The system doesn't reward merit. It rewards perception, and perception is shaped by whoever has the most money to move the market. Which brings us to the bigger question. Is this sustainable? Because what we're describing here is a system where the most important price in any economy, the value of money itself, is determined by a decentralized, largely automated, totally undemocratic process that operates faster than regulators can track and larger than governments can control. And it's not clear that anyone actually designed it this way. The foreign exchange market evolved. It grew out of the collapse of Bretton Woods in the 1970s, when currencies stopped being pegged to gold and started floating freely. The idea was that markets would find the right price for each currency based on economic fundamentals. 50 years later, we've discovered that markets don't price based on fundamentals. They price based on momentum, on sentiment, on what they think will happen next, and increasingly on what algorithms think will happen in the next 3 seconds. There's a term economists use for systems like this: reflexive. A system where the outcome is shaped by participants' expectations of the outcome, where trying to predict the future actually changes the future. Currency markets are reflexive, which means they're inherently unstable, not always catastrophically unstable, but unpredictably unstable. And the more algorithmic they become, the more reflexive they get. So here's where we are. The value of money, the single most fundamental element of economic life, is decided by a system that nobody controls, that operates based on circular logic, that can be manipulated by sufficiently large players, and that increasingly runs on automated decision-making whose logic even the programmers don't fully understand. You didn't vote for this. You can't opt out, and it's probably not going to change. The question isn't whether this system is good or bad. It's whether it's stable enough to survive the next crisis. Because every time it's been tested, it's come closer to breaking than anyone expected. And the next test is already on the way. We just don't know what it looks like yet.